Welcome to our explainer on asset classes. We're going to break down one of the most fundamental ideas in investing, so let's jump right in. I love this idea of an investment family because that's really what it is. If you can understand each family member's personality, what makes them tick, their strengths, their weaknesses, then investing suddenly becomes a whole lot clearer. So here's our roadmap. We'll start with what asset classes even are. Then we'll meet the main players in the family. After that, we'll see why they're so much stronger together. And finally, we'll touch on how you can actually blend them to build your own portfolio. Okay, first things first. Let's start with that big question. What exactly is an asset class? It sounds complicated, but it's not. An asset class is really just a label we use to group investments that are kind of similar. They tend to act alike in certain market conditions and have similar risk levels. It's how we bring some order to the huge, chaotic world of investing. And here they are, the core investment family we're about to get to know. You've got stocks, bonds, cash, real estate, and then those interesting cousins called alternatives. Each one has a totally different job to do. All right, time for proper introductions. Getting a feel for each one's personality is absolutely key. So let's start with stocks, also known as equities. In our investment family, this is the ambitious sibling, the one who's always reaching for the stars, totally focused on growth. So what does that mean? Well, when you buy a stock, you're literally buying a small piece of ownership in a company. And if that company does well, your piece becomes more valuable. This is why stocks have the highest potential for big returns. But, and this is a big but, they also come with the highest potential risk. You make money when the share price goes up, or sometimes through dividends, which are like little profit-sharing payments. Next up, we have bonds. Now, if stocks are the ambitious risk taker, bonds are the complete opposite. They're the steady, reliable sibling who brings a sense of calm and stability to the family. A bond is pretty simple when you break it down. It's just a loan. You're lending money to a big company or even the government, and in exchange for that loan, they promise to pay you back with interest over a set period. So what you get is a predictable stream of income. It's a whole lot less risky than stocks, but the trade-off is that your potential for huge returns is also much lower. And then we've got cash. In the investment family, cash and its equivalents play the role of the super cautious parent. Their number one job, safety first. We're talking about things like high-interest savings accounts, or GICs. This is basically the safest place you can park your money. The chance of losing your original investment is almost zero. But of course, there's a catch. The potential for growth is the lowest of all, and sometimes it doesn't even grow fast enough to beat inflation. All right, let's meet the rest of the relatives. Real estate and alternatives. Think of these as the unique cousins in the family. They march to the beat of their own drum. So you've got real estate, which is physical property you can actually see and touch. Then you have this whole other world of alternatives, things like commodities, gold, oil, or even newer stuff like crypto and fine art. The interesting thing is they often don't move in the same direction as stocks and bonds, which can be great, but they can also be harder to sell quickly and, well, a lot more unpredictable. So when you lay them all out, you get this beautiful spectrum of risk versus return. Over on the far left, you have super safe, low-return cash. And as we move to the right, through bonds, real estate, stocks, and alternatives, the potential for higher rewards goes up, but so does the potential for risk. This trade-off, it's pretty much the core role of the entire investing game. Okay, so we've met all the individual family members. But here's where it gets really interesting. This is about why they are so much more powerful when they're working as a team. Just take a look at this. It's kind of wild, right? Each color here is a different asset class, and you can see that the top performer changes almost every single year. Last year's hero could easily be at the bottom of the pile this year. There's just no single superstar that wins all the time. And that brings us right back to that classic piece of advice you've probably heard a million times. Trying to bet everything on just one asset class, even one that's hot right now, is a huge, huge gamble. And here's the aha moment. When one member of your investment family is having a down year, another one might be soaring. That's because they don't all move in the same direction at the same time. So by owning a mix of them, you smooth out the journey. The highs aren't quite as high, but the lows aren't nearly as low, which makes for a much less bumpy ride. So the big question is, how do you actually use this information? How do you put it all together to build a mix that works for you? Well, let's say your main goal is just to protect your money and get some steady income. You might build a conservative portfolio like this one. See how it's mostly made up of that reliable sibling, bonds? There's just a little bit of stocks in there to give it a small boost of growth potential. But what if you're on the other end of the spectrum? Maybe you have decades until retirement and you're aiming for maximum growth. Then your mix might look more like this, heavily tilted towards that ambitious sibling, stocks, to really drive those returns, while fully understanding that it's going to be a much wilder ride. And this is so important. There is no single magic formula. The right mix for you is 100% personal. It all comes down to your goals, how much time you have to invest, and frankly, how well you sleep at night when the market gets choppy. Answering those questions honestly is how you find the blend that's perfect for you. So let's wrap this all up. Every investment out there belongs to a family, an asset class, with its own unique personality. If you understand them and you mix them together wisely, you can build a portfolio that's strong enough to handle whatever the market throws at it. Is a powerful way to think about it, isn't it? So the question I'll leave you with is this. Now that you've been introduced to the family, how are you going to build your team?